All right, check out this trade from last week. RDHL, from Monday until Tuesday, the trade made over 150%. Now I'll show you why and when to buy the stock, but more importantly, I'm going to teach you something that every trader must know, but most beginning traders don't understand very well. Plus, I'll do my normal analysis of the markets. We've had a good turn in the market as I predicted in the last few weeks. And then we'll look at the trade of the week. That's all coming up in this week's Stockscores Market Minutes. So most traders are obsessed with when to buy, maybe when to sell. But one of the most overlooked areas in trading is how much to buy and when to take a loss if you're wrong. So risk management is absolutely essential to doing well in trading, because we're just not going to be right all of the time. You buy some stocks, you sell, you're sometimes going to sell at a loss. And so before you go into the trade, you need to know how many shares to buy to properly reflect your risk tolerance. So what I'd like to do is not think about what I can afford to buy, but what I'm willing to lose or what I can afford to lose. And for that, it's different for everyone. You could have $1 million in the market, but if losing more than $500 makes you uncomfortable, then you're taking on too much risk. So risk management is essential to success in the market, not only because we have to preserve our capital, but also because our emotions are our major enemy in trading. That's what causes us to make mistakes. And so to manage emotions, we must begin by managing risk. And so going into the trade, you always want to define the stop loss point and then use that to define your position size. Now I'm going to show you an example in just a moment and then another example at the end of the video on how we do that. So let's take a look at this stock from last week. This is RDHL, and it made a really good move on Monday into Tuesday and actually continued through the week. The reason for buying on this particular trade is a swing strategy I have called a simple swing. And what it looks for are stocks that are making abnormal breaks on the 13-minute chart. So there you can see an abnormal bar. And by abnormal, we mean the price gain was abnormal and the volume traded was much more than normal. Okay, so we've got algorithms on Stockscores that look for that. I have a service called Active Live where you can monitor the market with me all day long, and we look for these stocks that make what I call an action candle. They're abnormal price gain with abnormal volume. And when I'm swing trading, I like to do that on the 13-minute interval. All right, so that's the reason to buy. But now let's talk about how much to buy. Now the blue line here is our entry price. And the bottom of that candle is what we call R1. It's the risk line. And our actual stop loss goes at 2 times R. So if this space from here to here is R, and then we're going to go minus 2R for where our stop loss point is. So in the case of this trade, the entry was 84 cents. It's a little hard to read there because it's in blue. Just trust me, that's what it says, 84 cents. And the stop loss is going to be at 54 cents. And so now we can buy the right position size for our risk tolerance. If you bought 1,000 shares of this stock and your risk is the difference between the entry price, 84 cents, and the stop loss price, 54 cents, that means your risk per share is 30 cents for a total risk of $300 plus commissions and slippage. Maybe that's $10 or $20 more. All right. By slippage, I mean you don't get in at the exact price you want. You don't get out at the exact price you want. So there's always a little bit of slippage on every trade. You should count on that when you're trading. All right. So let's say you're willing to lose $1,000. Well, then instead of buying 1,000 shares, you might buy 3,200 shares. Times 30 cents is $960, and then you add on slippage and commissions, and your risk would be $1,000. So you always work backwards. When you're defining your position size, you work backwards from your risk tolerance. Start with how much am I willing to lose? And then what is the risk of the stock based on the entry price and the floor price, and then use that to define position size. Now, a common mistake that people make is they put the stop where they have their risk tolerance limit. So in other words, they'll go out and buy 5,000 shares and they'll say, well, I don't want to lose more than $500. And they might put their stop really tight because that's where they would be taking a $500 loss. Well, you can't do it that way. You have to put your stop loss point far enough down that the stock has some wiggle room, because as you can see in this example, this stock did not go up right away. The entry point was here, and it kind of waffled around for a little better than an hour before it finally started to move, and then it really took off into the next day. So what I like to do is always put support a little bit below the floor on the chart. I like to give it quite a bit of wiggle room, because it's really frustrating to be into a trade, get stopped out, and then watch the stock go right back up again, right? So you have to allow for some wiggle room. So we do that by looking where the floor is and then going a little bit less, and let that stop loss point define your position size based upon your risk tolerance. All right, now I'm going to give you another example at the end of the video from another stock that was really hot this week, and we'll walk through not only how to do that for a day trade, but also for a swing trade on the same stock. And we'll talk about the difference between day and swing trades. But now, let's get into this week's market analysis. We've had a pretty good market the last little while. We went bullish here a few weeks ago in the short term when the market started to turn. And if you go back and watch previous episodes of this week's video, you'll know that I've been bullish on the stock market in the short term for the last few weeks, and then on Bitcoin for the last few months, and it's really been doing well also. So the first chart that we have here on screen is that of the S&P 500. This is a 60-minute chart, and it's very simple. If the bottoms are rising from left to right, that means that the buyers are in control and it's an optimistic market. And so you can see on the short-term chart, buyers are in control, stock scores are in a good place. That means it's a bullish chart. However, if we go to the 3-year weekly chart, you can see that generally we still have the buyers in control. But my concern right now is we're coming up to this line of resistance here from the price peaks that were hit early in the summer. When you rally into resistance, it's very likely that you will get stuck at resistance. And so although I like the market in the short term, I do think that there's a good chance we'll see a little bit of a pullback next week. That would be healthy actually, because if I draw a trend line across these bottoms, I didn't draw that perfectly, but you get the idea. When you run away from the trend line, like we did here, it's inevitable that you're going to pull back a little bit. So we've run away from the trend line, we're at resistance, good chance, not a certainty, but a good chance that the market will pull back in the next few weeks. However, the momentum is still up, there's still good action, and that's how the large cap market looks. Now let's take a look at the NASDAQ market, and we'll jump to the 1 month first, and you can see buyers are in control, a little bit of weakness on Wednesday, and so perhaps we're just destined to build a little bit of a base here. But on that longer term time frame here, you can see that we've actually broken through that level of resistance. Now we're stalling, and we have this level of resistance here as well. So this market looks better than the S&P. The NASDAQ stocks look better, but still probably in need of a little bit of a pullback. Now, one thing I want to say that's really important about these indexes, when you look at the S&P, when you look at the NASDAQ 100, understand that these are market-weighted indexes. What that means is that the component stocks of the index are weighted by their market cap. So in other words, a company like Apple, which is huge, I think it's pushing $3 trillion market cap, it has a much heavier weighting than a smaller company in the S&P 500. And so that makes these indexes sometimes a little bit deceptive. Because if you go look at most stocks right now have not been trending higher. In fact, most stocks have been trending lower and are only now starting to turn. The market indexes have been pulled higher by companies like Amazon, Microsoft, Apple, these large companies that have a heavy weighting in the market, in the index, they're what's pulling this market higher. And it's when we dive into the small cap sector index, and for that we can look at IWM, there you can see that it's still got a lot of room to go. Now, a few weeks ago, I did a video saying this was the market to watch. The Russell 2000, the small cap stocks, in my mind, have the best upside potential because they have so much room up to resistance. And you can see that after building a base here for the last couple of weeks, we had a real strong rally on Friday. Now, why is that? Because the market is now thinking that interest rates are done going up, may actually go down sometime in the next year. And so we saw the bond market go up, which means interest rates went down, and that really helped the Russell, the small cap stocks, disproportionately to the large cap stocks. And that's exactly what we talked about in one of the recent videos in the past few weeks. That was likely to happen, and now we're seeing it this week. And I do think that the small cap stocks have much more upside because they have a lot of room up to this level of resistance. Now let's jump into the Canadian market, T.XIU. And the Canadian market has a much heavier weighting of commodity stocks. And so if we look at a 1 month chart here, we can see the trend is up, so that's a positive. Looking at the 3-year chart, you can see that we're still stuck in this sideways trading range that we've been in for over a year. We got a little bit of upside until we hit resistance, and so it's likely that we'll get there. But once we do, expect this market to get stuck. However, my experience with the Canadian market is you have many different markets in Canada. You've got the Canadian banking stocks. You've got the Canadian telecom stocks like Telus and BCE and Rogers, which all had very good moves late last week, and I think are going to be areas that actually go up in the next little while. And then you've got the commodity sector, the oil stocks, the mining stocks. They can move in a totally different direction from the overall market. So you can still find opportunity in the Canadian market by diving into some of those sectors that are leading the way. And again, one of those sectors that I think has good potential are the cellular companies. So if I look at a chart of Telus, T.T, look at that nice chart. We've got a downward trend. We built a rising bottom, and we broke on Friday from a rising bottom. And you can see here that volume is increasing. And the chart's quite similar for Rogers and for BCE. So there's something going on in the cellular stocks that had investors excited last week. All right, well, let's jump into commodities now. Let's take a look at gold. Gold had a really good week last week, better than I expected. You can see that the buyers are in control. Bottoms are rising, trend is up. And if we look at that longer term 3-year chart, we've actually managed to break out through this long-term resistance. We hit it once back in 2022, again in 2023. We were stalling here later in 2023, and this past week we broke out. You can see the Stockscores indicators have gone into the above 60 zone, which we like to see. The sentiment Stockscore is now 84. Could be a little pullback in the short term. It's a little bit overbought. You can see there's your trend line. We could pull back a little bit, but actually the gold sector looking pretty good, and that might be a place to watch. How about oil? Let's take a look at USO. And you can see lots of volatility in the last week, and the general trend on the daily chart is down. So the short-term outlook is somewhat negative. Now looking at the longer-term time frame, the 3-year, there's your downward trend line. It was broken there. Here's your upward trend line, and we're right at it. So we've fallen into the upward trend line where we should bounce in the next few weeks, but there's no sign of a bounce yet. So we'll have to wait and see if that happens. Okay, next up, let's take a look at the US dollar. UUP is the chart for that. And you can see that the US dollar, after being really strong for a long time, had a great run 2021 into the end of 2022, and then a good run here. It's now rolling over again. And so I think the US dollar more likely to go lower than higher because it broke this upward trend line on the weekly chart. So be careful in the short term if you are a currency trader being long of the US dollar. Now, one of the reasons for that is interest rates. Let's take a look at the chart of the US Treasury bond market. TLT is the ETF. you can see we had a parabolic trend to the downside. We talked about this in recent weeks as well, about how the bond market seemed to be reversing, volume was increasing, and that was a good sign that interest rates will stop going up. Remember, the bond market is inverse to interest rates. So if this is going up, that means interest rates are going down. So in terms of interest rates, it's a bearish chart. In other words, interest rates likely to go lower based on the bond market, but it's a bullish signal for the stock market in general, because if interest rates are going down, that's good for stocks, particularly those small cap stocks as we talked about at the top of the video. All right, last chart we're going to look at is Bitcoin. GBTC was bullish on Bitcoin, started improving the chart here, and then we had this nice bullish breakout back there, and it's been just straight up since then. And so I don't think it's a time to buy this. It's already gone up a lot, but if you're in it, it's a good hold. It's made pretty good gains even from here, 20 to 31. That's better than 50% in 6 weeks on Bitcoin. So my ratings then, bullish and neutral, short-term bullish, long-term neutral for all the stock markets. I'm now bullish on both time frames for gold. Oil bearish short-term, neutral long-term. Same for the US dollar. Bitcoin, I remain bullish on both time frames. And then interest rates, short-term bearish, long-term neutral. Let's be clear though, when I say bearish, that means interest rates likely to go lower in the short term, which of course is bullish or good for the stock market. All right, well now let's look at another example of how we can size positions based on the chart. And we're going to look at the trade of the week. And this week we're going to do something a little different, because the same stock gave a buy signal for a swing trade and also a day trade in the same day. So this is UPST. It had a good run on Friday. And this stock met the criteria of my swing trading strategy on the second bar of the day. This is the 9:56 candle. So 26 minutes into the trading day, it made an action candle. Now notice it made an action candle there as well, but that one was still below this trend line. Now these indicators that I'm showing you are indicators that I make available to my students who do the active trader course. You can learn more about that at Stockscores. And this is being plotted in TradeStation, which is a program that I have nothing to do with, but I think is fantastic. And I like to push as many people toward that program because I really do like it. I've been using it for over 20 years. But there's the buy point, and you can see that it went up quite nicely. Now let's size this position like we learned at the top of the video based on our risk reward lines. So this entry point is at 28.32, and our actual stop loss point is at 26.16, and what we call R1 is at 27.24. So essentially each one of these lines is about $1 in height, $1 in width. Okay, so every line is about $1 gain. It's a little bit more, $1.09, $1.08. All right, so if you're willing to lose $500 on this trade and your risk down to support is $2, then you would buy 250 shares. And here you're now up from the buy point about $4.50. So that means that this trade made about $1,000 in profit. Now let's take a look at another example where on the same stock, but this time as a day trade. So the stock initially started the day with strength. That's what gets our attention. It's abnormal. And then it goes into a predictive chart pattern called a rectangle consolidation. This is one of the patterns I teach people to look for. Very simple. There's the action candle on the 1 minute chart, because this is a day trade. So on the 1 minute chart we buy here. By the end of the day, it's up, well, it is as much as 10 times risk, closed the day at 9 times risk. So if you risked $200 on this trade, using that formula we talked about at the top of the video, that means your profit at the end of the day was $1,800. Nice day's work on a very simple concept where we look for abnormal activity to start, but just as importantly, we size our positions based upon our risk tolerance and the riskiness of the stock, which is really the distance down to our stop loss point. Well, hope you've enjoyed this video and learned something from it. If so, click on the like button. Let me know that you got something out of it. And if you have any questions, throw them in the comment section. If you have any thoughts on where the markets are going, love to look at those as well. I always read them. I don't answer all of them, but I'll try to answer some. Hope you've enjoyed this week's video, and trade well.